Hello and welcome to episode 13 of the Special Situations Report, a podcast by Inside Arbitrage, covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
This week we will briefly discuss the potential impact of tariffs on merger arbitrage, the acquisition of Mr. Cooper by Rocket Companies, a buyback announcement by a banking software company called nCino, an insider purchase by an independent director of the energy company APA Group, and a whole lot more.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
Before we get to regular programming on this podcast, we should briefly discuss the shock global markets experienced last week with the announcement of the Trump tariffs. I don't think anybody was expecting this level of tariffs, nor were they expecting tariffs to be calculated the way they were calculated. For example, when I saw that Vietnam was going to be hit with 46% tariffs, that was a big shock. The bigger shock, I think, was to the people of Switzerland when they noticed that they were hit with 31% tariffs, when they hardly have any reciprocal tariffs on our products. So it's a very fluid situation that's going to take some time to work out. And that's the reason we saw that global markets drop so rapidly, both on Thursday and Friday. And we ended at pretty much the lows of the sessions, both on Thursday and Friday, which means when the market opens on Monday, things are going to be very interesting and unfortunately very painful for a lot of people. But let's talk a little bit about the impact of a situation like this on M&A and merger arbitrage. The question really arises whether this event that we just experienced can be considered a force majeure event, something like an act of God, where people can use that to walk away from contracts. In other words, it's an unforeseeable event like a natural disaster or a war. And these tariffs could be considered as something like economic warfare. And hence, companies might say, like how Met Aerospace said last week, that they consider this as a force majeure event and they might halt some shipments to companies like Boeing and Airbus that use their parts in their airplanes.
Right, during the COVID pandemic, several companies attempted to walk away from their deals by claiming that COVID was a material adverse effect. And like you were saying, we might see something similar this time if the impacts of tariffs cause widespread economic distress. During COVID, Forescout Technologies sued Advent International, and Tiffany sued LVMH to make them close their acquisition, and eventually in both cases, the parties settled out of court and the deals closed, albeit at lower prices.
Yeah, you can't just walk away from deals after a definitive merger agreement is struck. Elon Musk couldn't walk away from Twitter, LVMH couldn't walk away from Tiffany. And if this situation is taken as a force majeure event and companies attempt to walk away, they most likely will be sued and will be forced to perform even at a lower price potentially if the settlement happens out of court. One of the announcements now coming to potential deals was an interesting one in the context of these tariffs. The US contract chip maker Global Foundries and United Microelectronics, which is Taiwan's second largest chip maker, are exploring a potential of a possible merger between them in order to mitigate the risks surrounding the Taiwan Strait. I'm glad we are discussing this potential deal first because I was thinking about why AI stocks have been particularly weak going into this tariff situation. So they were already weak to begin with. And one of the reasons is the risk that so many companies face from having their manufacturing exposed to Taiwan's semiconductor manufacturing company, or as everyone refers to them as TSMC.
Right, so instead of folding, China hit back with its own tariffs and restrictions on the export of rare earth metals. Now, if the US were to pursue a policy of going after Greenland, then what's exactly there to stop China from going after Taiwan?
Exactly. In that scenario, companies would have to scramble to companies like Global Foundries or even potentially Intel's foundry division for their manufacturing. And there just isn't another company on earth that can handle the kind of volume and advanced manufacturing that TSMC can.
Moving on to some current deal updates, one of the few companies that was up on Friday and up almost 10% was Guess. As we mentioned in our last podcast episode, the company received an offer for $13 per share from WHP Global. The co-founders of the company, along with the CEO, own almost 50% of Guess, and thus that'll have an impact on this acquisition for sure.
Yeah, it looks like they had worked with WHP Global on an acquisition they had done of Rag and Bone. So it looks like there's some familiarity between the two organizations. So this week, Guess retained a financial advisor and a legal advisor, and they also got a new CFO. So the company was up 10% on Friday, not just because, it's made these moves to hire a legal advisor and financial advisor, but they also reported stronger than expected earnings. And finally, when Vietnam agreed to strike a deal with the Trump administration to avoid the 46% tariffs they would have been subject to, a lot of these companies like Guess, Nike, Lululemon, all of them saw their stock price go up.
Continuing on with current deal updates, Capital One overcame an obstacle this week to acquire Discover Financial as they just received clearance from the Department of Justice. However, the deal still requires approval from the Federal Reserve and OCC, which could possibly block the deal from going through. The spread on the deal collapsed from nearly 12% to less than 4% in a week.
That was a deal a lot of people were concerned might not go through. So it was good to see a large deal like that starting to get to a point where it might cross the finish line once the Federal Reserve and the OCC approve it. The deal that we want to talk about this week, which is a newly announced deal, is the acquisition of Mr. Cooper Group by Rocket Companies for a closing value of $9.4 billion in an all-stock deal. Rocket had just announced the acquisition of Redfin. What was it, about 3 or 4 weeks ago? We were talking about it on the podcast. In a $1.75 billion deal, the spread on both deals, which is the Rocket Company's acquisition of Redfin and its acquisition of Mr. Cooper Group, blew up on account of the tariff-related drop in the markets. So the Redfin deal is currently trading at a spread of nearly 20% or 40% annualized.
Right, and the Mr. Cooper deal is trading at around a spread of 26% or 35% annualized. The spread is actually juicier than it looks due to a $2 dividend that Mr. Cooper will pay to shareholders once the deal closes. The issue is that given what has happened to volatility in recent days and the volatility in the market as a whole, it would be quite expensive to short the stock of rocket companies in order to lock down this spread.
Yeah, it's one of the reasons I tend to stick to all cash deals when possible. The other issue with all stock deals is that if the deal falls apart, you often get hit with a double whammy. The stock of the company being acquired could drop sharply, as you often see in failed mergers. But in this case, at the same time, the stock of the acquiring company, in this case, it would be Rocket Companies, could actually go up in price. So you could get hurt both on the long side because you have the target, and you could get hurt on the short side because you're short the acquiring company.
Getting back to the deal at hand though, while Redfin has more or less muddled along over the last couple years, Mr. Cooper has done very well compared to other mortgage origination companies. And given how high the stock was, it kind of feels like Rocket bought at the peak of the cycle. Mr. Cooper previously acquired Home Point Capital in 2023 for just $324 million in cash and picked up their $84 billion mortgage servicing portfolio.
Yeah, looking at that price chart was quite a shock, especially considering that it is a mortgage originating and servicing company, which haven't done very well the last several years. Looking at the timing of their sale to Rocket, I looked at the CEO of Mr. Cooper. He's clearly very smart. He was working on asset-backed securities for mortgage-related products, the stuff that actually took everything down in 2008, 2009. But he was working on that stuff at Bank of America in the 1990s. And he also led their portfolio acquisition, pricing, and modeling group at Bank of America. So very smart guy, and looks like he's going out at the top by selling Mr. Cooper Group to rocket companies.
Let's move over and talk about spinoffs for a bit. About 3 episodes ago, we talked about the planned spinoff of the home services business Angi from Barry Diller's IAC. IAC has spun out a number of businesses, and many of them are household names, including Expedia, LendingTree, and Match. But as of lately, their businesses haven't been doing too well. For example, Vimeo, which IAC spun out in mid-2021 if I'm remembering correctly, has lost over 90% of its value since the spinoff.
And Angi went public through an IPO in November 2011. But in October 2017, IAC announced that it was going to acquire the company and merge it into a digital marketplace called Home Advisor. The stock continued trading as Angi, but much like Vimeo, the company has struggled a lot over the last few years, and the stock is down a whopping 88% over the last 5 years.
This week, IAC and Angi announced the successful completion of the spin-off of IAC's full ownership stake in Angi. The transaction eliminates Angi's dual-class voting structure, with IAC converting all of its high-vote shares to low-vote shares prior to the distribution to shareholders. Joey Levin is also stepping down as IAC's CEO to become the executive chairman of Angi, partnering with CEO Jeff Kipp. About half a share of Angi for each IAC share owned was distributed to IAC shareholders as of record on March 25th. So it's interesting to see both this spin-off and the C-suite transition going on at the same time.
And they also have the buyback that they announced. I think in mid-March, they had announced a very large buyback. It was $445 million, representing 12% of the market cap. So it feels like things are kind of falling in place for IAC after these spin-offs and management transitions and so on and so forth. But speaking of buybacks, the one I wanted to briefly touch upon is by a banking software company called nCino. The company had gotten absolutely killed recently, and I'd been following nCino because a friend who works with a large number of financial institutions as a consultant mentioned the company to me several years ago. And he said, every bank I go into seems to be transitioning to nCino, and you should take a look at this company. So when I saw the big drop in the stock recently, combined with the buyback announcement, it really caught my attention. And it's a company that I'm going to start to track more closely, especially as we experience all this volatility and big drops in the markets.
I actually recognize the nCino name mostly because they used to pop up on our list of top insider sales. So it's interesting that your friend was talking about how good of a company nCino was while their insiders were out there selling shares pretty much constantly on the open market.
That's why you need that full 360-degree view, right? You track all the different events and you hear people and you talk to customers. And eventually, at some point, the timing might be right.
Speaking of timing, we were just talking about insiders, so let's move on to the insiders section of our podcast. Over the past couple months, we've seen the co-founder and CEO of the productivity management software company Asana buy shares. In fact, last week alone, he bought about $7 million worth of Asana stock. He actually topped our list of insider purchases, for this week. We've talked about Asana on the podcast before, after the unexpected news that none other than Dustin Moskovitz would be stepping down from his role as CEO as soon as the company was able to find a new CEO. That hasn't quite happened yet, so Dustin Moskovitz remains CEO, and that's what he's filing under as he purchases these shares. But down the road, we will see Asana get new leadership. And that announcement wasn't necessarily received super well. Asana's stock dropped 24% in a single day after reporting Q4 2024 results and announcing Dustin Moskovitz's departure.
Mr. Moskowitz, for those who are unfamiliar with him, was the co-founder of Facebook before he left the company in 2008 to found Asana. He's easily one of the most dedicated insiders of a company we've ever seen. He's been consistently buying shares at various points since the company went public. But looking at Asana's price chart, these purchases haven't been very well timed in the long run. The stock has lost 50% of its value since the company went public in 2020 and has fallen greatly from its highs of $140 per share in 2021.
Yeah, Asana trades at around $14 per share right now, so quite the fall for sure. It's interesting to see Mr. Moskowitz continue to amass shares of Asana even after he's announced to be leaving the company, and especially considering that he already owns 53% of the company's shares outstanding. I mean, at some point, how much more could he buy? Perhaps he's seeing this recent downturn as another opportunity to pick up more stock when Asana appears cheap or undervalued, but I'm curious to see how this all plays out at the end of the day. Even after he leaves the company, he'll be a 10% owner, and we'll still get to see his insider transactions, whether or not he continues to purchase or if he finally starts selling shares.
Indeed. And I don't know if you recollect, we were looking at the cash flow statement, and I believe they turned free cash flow positive last quarter, which is exactly what the CFO, the new CFO, Sonali, had done at RingCentral previously when she was the CFO at RingCentral.
Another insider purchase we wanted to briefly cover was by director William Douglas, who purchased a little over $500,000 worth of Dollar Tree stock. I bring this up because just last week we talked about Dollar Tree selling the Family Dollar business division or chain for $1 billion to the private equity firms Brigade Capital Management and Maslum Capital Management. This marked quite the loss for Dollar Tree, especially considering that the Family Dollar chain was acquired by the company in 2015 for $9 billion.
By the time this whole tariff tantrum is done, I wonder if it's going to be worth $100 million instead of $1 billion. But I'm just speculating here, so don't hold me to this. It's interesting to see the timing of this purchase, especially considering that the Family Dollar sale isn't expected to be completed until the second quarter of this year. Mr. Douglas was a formerly top executive at Coca-Cola for over 30 years until he retired from the company, and he literally just joined Dollar Tree's board at the end of February 2025. So this could be a typical purchase that we normally see when a new director joins a company's board. Nevertheless, I'm interested to see the direction Dollar Tree takes going forward. We've talked about tariffs a lot through the episode, but it definitely looks like Dollar Tree, like most retailers, will be impacted hard if these tariffs aren't rolled back in the next few days or weeks.
The last insider purchase we want to cover in this section is by director Chan Soo-jung at the oil and gas exploration and production company APA Corporation. APA Corporation was founded in 1954, so it's been around for quite some time, and has established a portfolio with operations spanning the United States, Egypt, the United Kingdom's North Sea, and it is also currently exploring Suriname. And this venture is possibly the most variable factor when it comes to the company itself.
The Suriname project is a joint venture between APA and the French company Total Energies, with both businesses having a 50-50% share in the proceeds of the asset, which is expected to generate 220,000 barrels per day of output. APA very recently announced a positive investment decision for their Suriname asset, with output expected to begin in the first half of 2028. So what's interesting here was I was reading your write-up about it for the Insider Weekends article, and it looks like the exploration costs of the venture are being split 50-50% as well. But the deal is very favorable for APA Corporation, as Total Energies is the one that is going to pay much of the capital expenditure costs upfront to develop the assets.
The other reason why this purchase stood out to us was due to who Chan Soo-jung is. We always like to look for insiders that have deep industry knowledge and also independent directors with an investment background. And Chan Soo-jung actually fits both of these categories perfectly, which is something we don't often see. He's been on APA's board since February 2011, so again, very deep-standing, long-standing history with the company, and was previously a partner at the private equity firm Warburg Pincus, focusing on energy investments. He also led the natural resources group at Goldman Sachs for over 17 years. I think he eventually worked his way up to be a managing director of the company, too. So, very, very deep investment background and an investment background with a specific focus on energy, which is what APA more or less operates in.
Yeah, it's worth mentioning here that it almost doesn't matter how much experience you have in an industry. If the industry is going through a cyclical downturn, it doesn't matter. Everything goes down together. So if oil prices are below $65 a barrel or $60 a barrel, deep offshore drilling is not viable anymore. It's valid, but not viable. And the same thing could happen if oil prices drop below $50 a barrel, right? Fracking might become less viable as well. Anyway, switching gears to activists, activist activity wasn't all that prominent this week. So this is going to be quite brief. Warner Brothers Discovery is expanding its board, following pressure from the activist investor Sessa Capital. Anton Levi is set to join the company's board, and he's coming over from the private equity firm General Atlantic, where he recently stepped down from his role as co-president. He remains an advisory director at General Atlantic, which makes sense considering he's been at the firm since 1998.
Anton Levy is best known for one of General Atlantic's greatest successes, that being investing in Alibaba in 2009 and netting an 18x return by the time the company went public in 2014. Other notable investments spearheaded by Levy include Facebook, Slack, Snapchat, and TikTok's parent company, ByteDance.
ByteDance is another company that's going through some turmoil about who is eventually going to end up owning that business,
Yeah.
who is going to actually end up at TikTok. It's good to see activist involvement at Warner Brothers. The stock has certainly been struggling over the last few years and is down 60% during the last 5 years.
Yeah, that's actually surprising to me because most stocks over the 5 year price chart as of lately looks incredibly good because it's you're seeing like the COVID related drop and then the subsequent recovery. So to see Warner Brothers kind of like subvert that trend has been interesting.
Yeah, and Warner Brothers merged with Discovery in 2022, which provided a great boost to revenue, but the bottom line was hit hard, which is why it's good to see this activist involvement. The company is very leveraged, and the merger added a fair amount of debt to the balance sheet. There was also some rumors, if I recollect correctly, about them potentially trying to merge with Paramount, but that would have been such an indebted company. I'm glad to see that that didn't necessarily actually go ahead and happen.
I wonder if that merger would have even been able to clear regulatory concerns at that point because you have Warner Brothers, you have Discovery, and then you have Paramount on top of it. Very much a consolidation in the media space. There's
That's
not
a good
that many
point. Under
players left.
Yeah, under Lena Khan's FTC, that would not have happened. Under this new FTC, maybe it stands a chance.
Right. But if not a merger, there is a lot of other special situations activity going on at Warner Brothers. In July of last year, the company first started considering splitting its digital streaming and studio operations from its traditional television networks in order to boost the declining share price, and that was more or less the explicit reason given. The CEO was rumored to be exploring options, including selling assets or forming a new company for the Warner Bros. Movie studio and Max streaming service in order to alleviate the group's massive debt balance as well. By December, the decision was officially confirmed. The declining cable TV businesses such as CNN were to be split from that streaming and studio operations such as Max, laying the groundwork for a potential sale or spin-off that hasn't actually been decided yet which one of its TV business as more cable subscribers begin to cut the cord. And the cord cutting issue is something that we talked a lot about in regards to Lionsgate whenever we would discuss the company. And Lionsgate did eventually separate its studio business from its streaming services. So that was interesting to see.
Yeah, the full spin-off is not yet completed. The studio business went public, and we just received in the mail this massive book, which is the proxy statement explaining what's going to happen with this spin-off of the Lionsgate studio business. And I look forward to some nice fireside reading with this book that they sent over the next few days. To wrap up our podcast episode this week, we'll dive into some of the most interesting C-suite transitions. Starting out with Macy's, the company's COO and CFO, Adrian Mitchell, is set to leave the company. Mr. Mitchell has been in his joint role of COO and CFO for a little over 2 years, and Macy's stock is unfortunately down 31% during his tenure. Mr. Mitchell first joined Macy's in 2020 as CFO. This isn't a sudden departure necessarily, since the transition was announced earlier this week or earlier last week, and Mr. Mitchell will remain in his role until June 21st of this year.
The news of the CFO transition is all the more fascinating considering the announcement comes just a few months after the massive accounting mishap Macy's experienced last year. In December 2024, Macy's revealed that an employee had made erroneous accounting accrual entries that ended up hiding about $151 million in delivery expenses from the fourth quarter of 2021 through the fiscal quarter ended November 2nd, 2024. After an internal investigation, Macy's concluded that there was no material impact to financial results for any historical, annual, or interim period, and that they were strengthening existing controls and making additional changes to prevent such an accounting error from ever happening again. I'm curious about how much of the CFO departure is tied to the accounting mishap in the first place.
Yeah, what's most surprising to me is not the departure of the CFO, it's the appointment of Macy's new CFO, Thomas Edwards Jr., who is coming over from, get this, Capri Holdings, where he serves as the CFO and COO over the last 8 years. Special situations investors may recognize Capri from its failed merger with Tapestry last year, which could be the reason Mr. Edwards is leaving the company. I was personally invested in Capri, lost money, and it's just surprising to see that this company that was trying to essentially roll up several brands. So they had Versace, they had Jimmy Choo, and Capri, which is Michael Kors. And they were trying to merge with Tapestry to create a 6-brand portfolio company. And guess what they're doing now? They're trying to actually get rid of both Versace and Jimmy Choo and sell that to a different company.
Interesting. So very much change in strategy there. Capri was down about 50% during the course of Mr. Edwards' tenure at the company. So I'm curious to see how Macy's fares under his leadership. But yeah, as I was researching this, the first interesting part, then what drew us to the C-suite transition in the first place, was that Macy's CFO was leaving just a few months after the accounting mishap. And the moment I realized it was Capri CEO or CFO, coming over, that was all the more shocking. So
maybe finally unlocks all that real estate value that has fascinated investors with Macy's for the longest period of time. And unfortunately, that hasn't yet quite played out. We're going to wrap up this episode by talking about Intel's chief people officer leaving. By itself, this wouldn't have been news we would have covered, but it just goes to show that Lip-Bu Tan is shaking up things as the new CEO of Intel. It's going to take him some time to turn around this massive ship, if you will. But this is one of the signals you start to see where you start seeing the entire management team shook up. You start seeing spinoffs and you start seeing some of these other announcements. So it looks like he's already started that process, and we'll see how it all plays out over the next year or two.
absolutely. And with that, we'll have wrapped up episode 13 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool. Check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you might be listening on, and especially share it with your friends who are interested in special situations. Thank you.